When companies do ethically questionable things, people love to throw out a warped Milton Friedman quote and the perspective that companies exist exclusively to generate profits they can pay to their company owners, their shareholders. But this is a pretty immature perspective that has created a lot of problems for us. And yes, making money is the primary function of the business. But what often gets ignored from Friedman is the recognition that there is a difference between societal distractions and ethical business. And the reality is, companies don't exist exclusively as a number on the stock market. Looking at them that way ignores the reality of their existence. You can't ignore the inputs or the impacts, the resources they consume, the waste they create, the stuff people use, the humans that create most of the value. 90% of the value of the S&P 500, the biggest 500 companies, is intangible assets, right? Intellectual property, data, software, brands. That's up from 17% in 1975 when Friedman was talking, when most of the value of a company was its real estate, its machines, its infrastructure, its equipment, right? But now people, employees create value. Customers ascribe value to your brand. Ask a CEO what the most important thing to the success of their business is. They will say talent. Of course, shareholders are important. They help the company start, grow, expand. A high stock price gives the company more capital. They should be rewarded. But where this perspective gets diluted is in the warped idea that a company's only duty is to make shareholders more money, ignoring everything else. That perspective is what got us the opioid crisis. More Americans have as a handful of companies ignored their moral responsibilities than from any other war besides since World War II. We as adults have responsibilities. Businesses have responsibilities. I mean, look at Boeing. It embarked on a well-documented 20 years of cost-cutting and outsourcing, focusing on boosting dividends and share returns, and it worked until those decisions caught up with them. In the last 5 years have wiped 50% of that shareholder value off the table with a series of crashes, leaving hundreds of functions and the recent door blowout and everything that has come since. In retrospect, the dividend lost to shareholders would have probably been better invested in their workers, their safety controls, their product quality. Would companies be reporting better sales and market share today if they had focused on keeping prices a little lower for people and rewarding shareholders less these past few years? I mean, that's how Walmart just took over as one of the biggest grocery players, but keeping prices low for the last few years. The period of ignoring long-term consequences and responsible decisions in favor of short-term shareholder profit maximization is over. Businesses need to be models of accountability and extend their perspective beyond 3 months at a time.